Hello, hello, hello. What's going on, everybody? Round number 2. Be Rad Cooley. It's not a video without you, but you're going to see it on the replay tomorrow. What happened to the West video? I was watching it last bit and restarted a bit and then lost the video. It said it went private. What's going on? Round number 2. Investor Jerry, where are you at? Where are you at? All right, so check this out, guys. I want you to sit down, pour yourself some nice coffee, pour yourself some nice beverage, whatever of your liking. Sit back, relax. This video is going to be pretty chill. What's up, top dog? Jerry, hello. Oh, hey, it's LCSO 101. Don't confuse this with Investor Jerry. This is the other Investor Jerry from a different metaverse, right? Chilling with the dogs. What's up? All right, guys. So, right now we're chilling with some good old Napa Valley. Wanted to just go ahead and just have a nice, sadly with ibuprofen, because I can't really enjoy anything with, depends on the sugar content, but we're going to enjoy ourselves with this here. So get yourself a beverage of your choice, sit back, relax. Now, we're going to be doing a couple things in this video. We're going to add a couple things that we talked about from yesterday. But what I wanted to do is there were a couple things that happened yesterday that I wasn't really proud of myself. I didn't like the video yesterday because we got it's you have been talking, you have been doing this, you have been doing that, and then all of a sudden I just see them all making fun of Steve Weiss, and personally I think that's kind of messed up. I think that was kind of not right. Yeah, he had a bad call, and yeah, he tried to be humble about it, but they kept on digging the dagger. But he said some really silly things that it would, as a YouTube channel designed to democratize financial literacy, it's important because, these folks, CNBC has they have 2.91 million subscribers. So if you can just kind of subscribe to our channel, please subscribe, please. Just kidding, right? No, but fast money traders talk the market is losing momentum. Now, it's true, breadth is going down, but honestly, every time it goes down, it's really a good time to buy. But there's a lot of videos in here. Tech bullpack is evident how nervous the market is getting. So do you remember that one time where Tesla was going down and they said, or Meta was going down? I mean, I can give you a lot of examples. And they come on, guys, they go ahead and, all these things pull down, and ultimately, it was the best time to buy. I mean, since, because sometimes, people on the channel, sometimes they're new and they don't follow all the videos. So might as well. Let's go ahead and do this here. So let's open up audio. Okay, let's say Jim Cramer cries about Meta stock. Yeah, this is good. So this is good. So you can see this here. So this video was published on October 27. Now, the thing is, this was posted by another person. So I don't know if, was it October 27, 2022? Right here. Wow. So October 20, this is how funny this is. Okay, so, I mean, you really can't make this stuff up. So this was posted on October 27, 2022. And it was posted right at the bottom of Meta, at the V-shaped recovery of Meta. We already know CNBC doesn't work for us, right? So do you think CNBC's Jim Cramer, do you think he said this is a buy now because it's very low, it's pessimistic, or was he like saying don't buy? Because obviously, hindsight's 2020, but you can look at it and say, well, if you would have bought here, you would be up a 5-bagger, right? You'll be up almost 5 to 6 bags. So let's see what he said, and then we'll go to Steve West. What I'm trying to do is let's share the audio version here. In fact, I just need one headphone in my left here. So let's go ahead and listen to this.
Free cash flow last year, $9.5 billion, now less than $1 billion.
So you see how it dropped down to 100, and then he was just crying.
Yeah, let me say this about this. I made a mistake here. I was wrong. I trusted this management team. That was ill-advised. Hubris here is extraordinary, and I apologize.
Okay. What did you get wrong?
And he's quiet. I didn't get nothing wrong because, I'm trying to have my hedge funds buy as much as I can because that's what I like to do, and have retail investors to sell, right? So the point is this is another example of where people are saying it's wrong, but you know the graph that we have, right? In regards to be fearful when others are greedy. So when Meta was going down in October, it was actually right here. This is 2022, right? You know how you have like January, February, March, April, May, June, July, August, September, October. So October was peak fear, right? So let's share this tab here. So you remember how like this tab, it's called the put to call ratio. The higher the line, the higher the puts. So, I mean, the question is, can you mathematically model emotion? And my answer is yes. So if you go to 2022, and you know how you have like January, February, March, April, May, June, July, August, September, October, right? Well, this was October 2022 when Jim Cramer was saying that, I was wrong, I'm emotional, yada, yada, yada. It was peak fear. And if you go all the way up with the S&P 500, this is the S&P, this was the perfect time to buy, right? And it's just, the point that I'm trying to tell you is, how do I say this? I mean, it's pretty simple. You're not going to become wealthy watching you're not going to become wealthy watching people like this. I mean, do you seriously think Wall Street would allow such good information to circulate, people to watch this stuff? I mean, do you really think that this would really be a kind of information that because a lot of folks, unfortunately, they how do I say this? They think like, oh, okay, real investors go on CNBC and they just listen. They just listen to CNBC and they make trades. And you literally have people that just have CNBC on. They're like, I'm going to practice day trading, and they just listen to CNBC. And I'm just like, an investor is the most very lonely job, I think, out there. Kind of coupled to a radiologist, diagnostic radiology, just kind of in a dark room, right? And, it's, you really got to be comfortable with looking at a spreadsheet and looking beyond a spreadsheet. And it's not as glamorous of what you might, I mean, I like it. I like looking at numbers. So, but anywho, so I just wanted to point that out. That's something we didn't talk about yesterday. It's a late here in New York, bro. All hail our cult leader. I'm here for the Saturday night cult get together. Let's do it, right? Al Stock Trades. I'm just kidding. What's up? How you doing? What's going on? Saturday Night Live. What's going on, Judy? So yeah, you know, pick your beverage. I'm going to sip on mine. Occasionally, I'm going to be quiet for a little bit. And that's because I'm enjoying a beverage. So just, you know, give me a moment to just smell the aroma, please. Ah, so good. Mm. Oh my God, I'm enjoying some cheese and chocolate too. Okay. Hot chocolate? Nah, not hot chocolate. Not today. Not today. What's going on? What's going on? All right. So, yesterday we talked about kind of Steve Weiss in regards to this. This is kind of the Humana Steve Weiss. Within the spam of in January, he went from I'm a buyer to seller to buyer and to I mean it's too. So we're gonna go over this. So let's just open this up real quick. Let's slap this on here real quick. And let's just open up Humana real quick, just so we can kind of get a understanding here. I'm not going to go over this, so I need you to memorize this. So Humana's down 45%. So on January 2, he said, sell Humana. It seems like a pretty good moment, right? Sell. He saved us a lot of money, right? He pretty much told us to sell at the top. That's a pretty good call, Steve, right? But then all of a sudden, on the 8th, the stock dropped like $10. So it was at like 470. And then on the 8th, it was 460. So the stock dropped like, you know, about 2%. Then he said it's a buy. Okay. The problem is all the way from January 8 to January 25, the stock literally dropped from like 460 down to 355. I mean, that's a pretty steep drop. We could calculate it by doing this, dragging it down. It dropped 22.87% to be exact. In 17 days, you lost pretty much 20% of your money. And obviously, you know, for folks that held, you know, they're down 44%, right? But, you know, and then January 25 comes around because you know how he said sell. He said buy in the 8. He said now sell on the 25th, and the 25th was right here. So he pretty much said sell at this dip, right? And then on October 2nd, he went ahead and he said, at this dip, he said, you know, right here, he said buy, right? And then you could see all that hard work. You know, first it was good, but then all this hard work, you know, 3.7, you know, it's not, you know, he's net down. If he were, let's say, if he were to sell here, he would still be net down 20%, right? Because you'd have to get up like 40% plus. So let's just kind of exit this out now because I'm not going to put this here. Let's exit this out and let's just kind of watch the videos. Okay. So let's watch this one and we're just going to comment when we need to. Okay. Okay, good. So let's listen to this.
I wanted to take some losses against the gains. Humana I went into as a trade, as you recall. And
As part of your profitable healthcare trade, which you were trying to ride for much of last year.
So I sold Humana on Friday as well, so I missed the move today. So, you know, you can't catch them all. But I haven't sold any United Healthcare. And, you know, my intention is to come back to Humana. But first, I want to see what happens we're in a very highly charged political environment. It typically is a discussion during presidential campaigns.
Healthcare typically underperforms in a general election year for that very reason. Both sides are just teeing off on the drug companies and about prices, this, that, and the other. And that's why those companies traditionally don't do well from a stock standpoint in GE years.
But I think some of that underperformance, frankly, was pulled forward. The markets move a lot quicker. They discount a lot sooner. And it's been no secret they underperform in the election years. But there are no positive catalysts either. And then you've got CMS, which who knows what to do with rates. So I thought it was prudent. Bottom line is that it was a loser in the portfolio. I had gains. So how am I going to manage that? So that's why I sold it. I also sold Deere. Deere was a profitable trade, but that was just a trade. I was very clear when I went in. It did very well. Deere has been trading between like 370 and 400. So I caught it. I've caught it each time, and I want to get out of it. I don't believe, and that's because I don't believe the economy is as strong as narrative in the market. And so I want to take that profit off. So I just thought and I missed that. It's up a little bit today. So I just wanted to rebalance the portfolio a little bit. I didn't want to wait till when everybody else is doing it. Okay, so that just gives me optionality. So I'm sitting with a lot of cash right now. I do intend to deploy it, but if you take a look where I put some money to work.
So anywho, this is kind of the gist of things, right? So here's January 2nd. Then the 8th, he goes ahead and he says he's a buyer. And then, Berber, I told you, as soon as he said this, the stock dropped 20%. So that was a bad call. Let's see what he says. Okay. This was January 8th one. Let's see what he says.
Weiss, quickly, because I want to move, but you do have an interesting move here. You explain it to us. You re-entered Humana.
Yeah, I
What's up
did.
with that? Because you sold out of it completely.
Yep.
Now you're back?
Yeah, I mean, it's called trading.
No, but why did you do that?
And so, well,
you didn't sound like you were, your description the other day, thank you for the description, by the way.
Yeah.
You didn't sound the other day like somebody who was out of it for, the weekend and you're going to get back in.
Look, when I worked for Steve Cohen, what he said was they had limits.
So here's the thing. They're pressing him, and you can study body psychology. Look at his legs. Look at his legs when he tries to think of a response.
Yeah.
You didn't sound the other day like somebody who was out of it for
Look at his legs.
the weekend and you're going to get back in.
Look, when I worked for Steve Cohen, what he said was they had limits, and this is at Millennium and this is elsewhere, where if a stock falls a certain percentage,
Now
or
you're
whatever
name
it is,
dropping and going down your resume.
yeah, I am. It's pretty impressive, is it not?
Where else were you at?
You're just going down the wrong
pretty
road today. I
impressive.
could tell with the moves.
But look, you know,
Keep digging a hole. Go ahead.
sometimes you got to get out of a stock, okay, and just think clearly about it, and then you go back in. I predict you.
So this was our famous line that we always say, sometimes you gotta get out of the stock. So this is his advice. Okay. Okay. Again, grab your beverage, sit down, relax, enjoy the beautiful American dream. We live in the best country in the world. For all my other people out there living in the international, sit back and enjoy the beautiful technology we have. YouTube. We're all sitting down, learning together. So and excuse my dog. He likes to bark. That's what dogs do, right? So this is what he said. Let's just replay it again because I think this is very important, right?
And just think clearly about it, and then you go back, okay? And just,
Go ahead.
sometimes you got to get out of a stock, okay? And just think clearly about it, and then you go back in. I predict Jim's going to.
So sometimes you have to get out of a stock to think clearly about it and then get back in. So you're telling me sometimes I have to sell a stock, and then if I'm profitable, pay my capital gains tax and think about it and get back in. And then no wash sale rule, right? Depending if it's 30 days or whatever. Even then, you still secure the capital gains tax. That's for lost cases. The point is, I'm honestly, I'm curious. I'm curious because just from an educational perspective, this is our stock terminal. Again, for folks that are interested, we do have our New Year's sale. There'll be a link down below. We've put in a bunch of courses, and uploaded a lot, like what is a stock, primary, secondary markets, all these things, and these are all the things available. We're gonna put more stuff, and for now, limited time, we're gonna have a 2.5 billion outputs of institutionally graded data. It's lifetime access to the stock terminal. And this is not the subscription, but it's included in there for lifetime access. And we will be increasing prices. I just wanted to point that out before I forget. So what I want to do is I want to share the screen here. Ah, man, you're so funny. That's so funny. Okay. Let me see. Yeah. Yeah. So based on Warren Buffett type investing, do you believe in this statement that my friend stated? Sometimes you have to get out of a stock and think about it. Just to think about it before getting back in. Is this a wise statement? Can you please give me a detailed response? Because I'm honestly curious. Maybe I'm wrong. Maybe Steve, has something that might enlighten us all. So your friend's statement touches the crucial aspects of investing that aligns with principles of value investing, championed by Warren Buffett. Mental clarity, right? So reevaluation of fundamentals. Okay. Market noise. Okay. Opportunity cost. Okay. It holds merit. Okay. What is the downside of this thinking? Because we went ahead and looked at the positive side. What's the downside? So missed opportunities, emotional decision making. You can read the rest here. Loss of market context, long-term commitment, increased transactional costs, and also taxes. That's the thing that I had on. Again, it's a, I get what he's trying to say, but that's not what I do. I mean, maybe, depending on the company, but it's not something that I do. So there's that. So let's go ahead and just listen to the rest of it. And this is when he said he's a seller. Oh, sorry, he's a buyer. He's a buyer. He's a buyer at January 8th.
To go back in and Boeing some
This
point,
is
right?
actually a great point.
Right? So I took a fresh look at it. It was a losing trade, and I look at it as that it got exceedingly cheap at 14 times this year's number, 12 times next year's number. Talk about a contrarian play. Look at the stock price. It was hated. So it's a good counterbalance. If you look at it today, this morning before NASDAQ really ripped, this was ripping. So it's a counterbalance to my tech exposure. So that's why I'm in it. So it's still a trade.
You think this sector is going to have a good year?
I think certain stocks can have a good year. Look, it's not news that election years are trying, but we've got so much other crap going on and so many other narratives. I don't know how big a focus is going to be on healthcare. I don't know how much the voters care about healthcare.
Yeah. So, the whole counterbalance and all that other stuff he was talking about. I've been in the market for about a decade. More than that. I don't know what he's talking about. So, I get what he's trying to say with the tech and counterbalance it with this, but yeah, that's just, in my opinion, a bunch of hoo-ha. So then January 25 rolls around and the stock dropped 22%. I mean, it dropped a lot. Okay, it's really bad, right? And here, this is where, and I get it, they're trying to hold him accountable. And the market, is attacking him. But ultimately, they drive the knife a little too deep. And this Steve guy is one of their own. But you go in and listen to CNBC now, and you have people that actually do research. Like, for example, Tom Lee, he does his research, right? And we've actually exchanged a few words. So it's really, he likes our research. So I like, again, people that work hard, we notice each other's work and we like each other. So that's good. So he's definitely looking into Clover, and especially once it becomes profitable. He's a chartered financial analyst in terms of, I believe, by training. So he was one of the chief head strategists in Chase. The thing is, you have CNBC that tries to act like they're doing retail a good service here by insulting this, just nice. He's a nice man. He messed up, and it's fine. We're all human. Like, we're all human. You don't have to be an asshole, right? But if you listen to them and you bring good research today, they would say, I don't know, it's too hot. The market's doing too well. And then all of a sudden, the market's too well, and it's counterintuitive. It's kind of they're doing the same crap, right? Like, you don't want to listen to these people. You want to listen to the real people that do research. But anywho, they drag in the dagger too deep here, and I think it's a little mean. But anywho, I think the next one is really mean. But yeah, listen to this.
You had been talking about profitable healthcare. Well, I don't know. What do you?
It's like, you have been talking about profitable healthcare, but I don't know. It's pretty mean, but it's okay.
What do you say about this?
Yeah. So look, a bunch of lucky things have happened to me. So I'm waiting for the disasters, buying, we'll get to one of them, but, let's talk about Humana first. So yeah, I put it on as a trade, you recall, last time I was on the show, which I think was January 9th. And because I had been losing money in it.
It was the 8th, not the 9th, but it's okay.
I put a stop on it, relatively tight stop. So got stopped out last week. And at the same time, I sold United Healthcare, which was basically slightly better than break even. They're just not working. And now you're getting into the election year where it's going to be even tougher. But when you take a look, they make money off their MLR, the medical loss ratio, which is now at 90%. And that is really high. You want that to be closer to 80%. So you're still seeing, and nobody knows this for sure, and clearly Humana didn't know it because they just don't have that type of visibility. There's so much change going on in healthcare. The government is pushing Medicare, which is where they are, CMS, to shift the risk to the provider. So in other words, instead of fee for service, you go and they say it's $100 for the visit. What they're doing now is they're saying, okay, for this patient in this category, we're going to give you $50,000 for the year. And if you make money on that, great. If you lose money on that, then that's your thing. So people are really changing around the healthcare system. And in addition, you still have the backlog of pandemic visits and surgeries. So usage is going up quite a bit. So all that is the perfect storm for Humana with their Medicare Advantage. And we may see it fall into United as well. So it became much too difficult. United's always been a permanent compounder. I'm sure it'll return to that, but at this point, I'd rather stay in the sidelines.
Okay, well, he does say some important things, ladies and gentlemen. I mean, you can't ignore what he's saying, right? I think he needs some of your cheese with with his little wine. Oh, poor guy. No, but he does say something important. He is saying something that he is saying something right. And I think it really speaks a lot about kind of what's going on. He says that these stocks, they're just not working. And I just want to take a moment to talk about this factually, right? Because, it's true. These stocks are not working, right? So the highest market cap for United Healthcare was around $577 billion. About $106 billion left, United Healthcare. About $43.7 billion left ELV. About $25 billion left Cigna. About $85.8 billion left CVS. And this is really sad. About $39.3 billion left Humana. And about $24.85 billion left Centene. So if you were to total all the billions, approximately $326 billion left the healthcare industry this year, right? in some cases for like I think CVS for the past 2 years. And the question you have to ask yourself is, why is the money leaving? Why are these stocks not working? And obviously we talked about this, right? We talked about it, and it has to go back to intrinsic value, right? I mean, if you were to go to the second annual letter from Warren Buffett, before it was called Berkshire Hathaway, this was a letter written in 1957 by Warren Buffett. And you can see, my view of the general market level is that it is priced above intrinsic value, right? The point is, who cares about what happened in 1957? The point is it's a terminology that's being used, which is intrinsic value. Now, here's the problem. When I first started this, so it's called medical loss ratio, also medical cost ratio, and there's MBR as well. So yeah, there's like money names for it, and that's just kind of the this is why our lifetime access mastering course, there's a terminology section where you learn kind of the outstanding shares, share flow. These are just terminologies that you can't become a surgeon without knowing the anatomy, right? It's you don't want a surgeon that's never taken anatomy, right? I don't think that'll ever happen, but you never know. The world can throw you some cases, and you never know the simulation we live in. Sometimes people slip through, but you can't do the stock market without understanding the words. I mean, you can, but you're just go ahead and go donate your money to charity, because that's going to be better than donating it to the Wall Street folks, right? So the point is the intrinsic value of these stocks have changed. Now, since I have Humana pulled up, we can pull Humana. Humana, about 39 billion left this year, right? You have to ask yourself, why, right? This is the financial sheet for Humana. And you can see that Humana's again, you go to free cash flow, and this is the years. You just have to follow the years, right? It's not rocket science. Anyone can do this, right? You can do this. TTM just means trailing 12 months. So it's pretty much like another way of saying kind of like this present, like this year, right? And you could see they're down negative 4 billion. Again, because these numbers are in millions. So like 1,000 million is equivalent to 1 billion. Since these are like, that's like almost like, that's like more than 4,000 millions. So you just, it's like that's another way of saying 4.1 billion. So Humana is negative 4.1 billion in free cash flow. So we went ahead and we calculated the last 5 years of free cash flow. And we went ahead and did them at a 2% growth rate, which is what analysts are expecting them to grow 1.68, just rounded it up. And we used 120 shares outstanding, which is this right here. And then you see a recession of 66, a bull case of 169. So what this tells me is that I think the destruction of Humana is just getting started. Now, obviously, this could be different. This could be different because if they grow more than 1.68%, then obviously it could be bullish. But also, if they grow their free cash flow more than what we had here, which is 1.1628, 1.6 billion. So we could. It's tough to say, guys, but what we can do is we could just open this up in a right tile format. Can we do that? Yeah, that didn't really do anything that I wanted. So we could just kind of, oh God, we go like this. Can we do that? Okay. And then let's just kind of pull this like this. Honestly, guys, this is not helping me. So what I'll do is I'm trying to open up another intrinsic value. Okay. That's what I'm trying to do. Okay. So let me just figure this out. Okay. So let's open up another intrinsic value. Let's open up light mode here. Now, this is tough, guys. I'm not going to lie, because it's very hard to determine what the free cash flow is going to look like, because they are negative. So there's a disruption, and I don't know what they're going to do. So, I mean, we can have them grow. Let's say Humana is able to recover, and let's say they recover their free cash flow to like 3,500. That's fair. Let's say 3,500. But let's have them grow at 2%, 1.68, and then let's go have them grow. They have 120 million shares. So this is where you get that 360 in the base case in here. The problem is we're saying they're going to grow 3,500. The thing is, last year when the disruption wasn't even happening, they weren't even growing 3,500. So again, it's tough. It is really tough, guys. It is tough. I mean, what we can do is isolate Humana, because what I'm trying to figure out is what could be the price of Humana next year. And it's hard because it's going to positive and negative free cash flow. And the question is it going to still remain negative, or are they going to rebound? And what is it they're going to rebound? I mean, we did it yesterday for 1.6 billion. So we had a 1.6 billion rebound. The question is, I really don't know. So it depends, because last quarter they lost $10 billion in free cash flow. So perhaps maybe just maybe we might be able to put them, let's say, at $2 billion. You see, and then it's at 207. But if you grow them at 0%, 184, and then it was 1.68. It's tough. It's tough because we took the average yesterday, because we did it objectively, right? We took the average free cash flow, and we'll have to figure it out later, but we took the average free cash flow, and I would say the price target is anywhere between 150 to 190, right? So I don't know, let's say 150 to 200, right? I'm not too sure kind of what Wall Street thinks. I think Wall Street lost a lot of money. So I think that they're not really going to be telling you the price target truth. Because they're trying to have the stock to go up so they can sell it out. But I'm not really seeing anything. I'm seeing a lot of 250s for price targets for Humana. I mean, we can open up the terminal and check. Let's look at price target consensus. Let's look at Humana. Let's see kind of what the consensus is. So we could say the median is around 259. So that's pretty much right around what it is. So again, I don't know. Right? I don't know. If you go ahead and take a look at what Tip Ranks is saying, you can see the price target average is around 281. So it's right around. That's what it says its middle value is. But I think the low is 248, which is kind of right around here. So again, our platform has the data, so you don't have to pay whatever money they charge. So that's the cool part, because we get our data directly. So, yeah. So anywho, the point is if Humana was seriously undervalued, why aren't they issuing a share repurchase buyback program? I mean, I haven't heard of it. Correct me if I'm wrong. And also, they're pulling out in a lot of areas now. And I've heard from the Vine, the beautiful wine vine that a lot of folks that are in Texas, they're not selling, or they don't want to sell Humana Medicare Advantage. And it has to go back to what we talked about earlier in the past when we're talking about the commissions that Humana stopped paying. Right? So again, I'm just chilling right now. I'm very excited. I'm very happy because I don't know what to tell you guys. I'm pretty happy, right? Because I think if you were to look at the disruption, I would say the closest one we're nearing is Humana, and I think our market cap is gonna at least. Humana lost 39 billion, and now it's about 30 billion. I think we might get to $5 to $10 billion, if not more. Again, not financial advice, it's just speculation. I think that's around a $10 to $20 stock price, right? So for Clover. So I'm just, again, guys, I'm really excited because this is a big deal. So let's just, before we get into the numbers here, let's just watch this last video, because this video was kind of sad though, because they really hit him hard, and you started getting faces and face reactions like this, face reactions like this, and face reactions like this. And they just kind of threw their colleague under the bus. So that's kind of sad. And then they like, good host, the way they grill vague investment managers. The problem is this guy works for CNBC. So anywho, it's all a show. So let's go ahead and just kind of share the screen here. And let's listen.
Let's pull up shares of Humana because this is the worst day, I think, in a couple of decades. They had a drop in the Medicare Advantage quality ratings, and that is a big threat to revenues. Stock's down 16%. It was down more than 22%. You bought it, Weiss.
I bought it on the news, so it's actually been a good little trade. I'm only going to be here for trade.
Like what, like 10 minutes trade?
I drive it. No, it's been longer than that, actually.
No, but you know what I mean. Like,
no, but
here's my problem, okay? I want you to give as much context as you think you can give.
I'll give it.
To how long you think you'll be there. Because if we're mentioning it on the program and then you say it's for a trade, which is respectfully, of course, you can do whatever the heck you want to do. I don't want to give people the impression that this is something that's going to be around for a while. What does that mean?
Okay, so if it continues to move up, so I've got a lot low cost here. Stock was down over $60 when the news first came out. The news is very significant. Normally, I would buy this and hold it for a period of time, but here's what the STARS rating means. The STARS ratings are what drives consumers to the plan. So if you got a 4-star rating, right, that means you're more likely to go, consumers will be attracted to it. If you have
So he pretty much basically said what Clover's doing, right? He said that if you have a 4-star rating, people are going to come to you. And that's really good because you're starting to see that's what Clover, like they talked old is good, but Clover's doing it. But then let's just very quickly pause for a sec and let's look up another video. Jim Cramer, Clover Health. And then, let's see. Mad Money. Is this the one? Is this the one right here, guys? This is it.
It is time. It's time for the light round because everybody want to go there. I know that it's.
There it is, right here. Let's see here. I think it's right here. Boom, boom, boom. Right about here. This is where someone calls in.
I'm fan I think you should just go buy Palantir. Let's go to Joseph in Florida. Joseph.
Hey, Jim, how you doing?
I'm doing well. How about you, Joseph?
I'm fantastic, man. So what's your take on Clover Health, ticker symbol CLOV?
Oh, man, I don't want to I know they're doing well. United Health, after what happened the other day with the medical care advantage, I just don't want to go there. I know that it's a good company, but I just don't want to hurt anybody. I'm sorry. So let's go to David in Texas. David.
What is that supposed to mean? What is that supposed to mean? I don't want to hurt. I don't want to hurt anybody. I mean, you can see their face. I don't want to hurt anybody. Like what? Like he doesn't want to hurt the incumbents. Guys, listen, guys. Again, get a beverage. Let's just have a real talk about this, right? Let's be honest, okay? No one thought, because I don't know if this is like gaslighting or just kind of just Wall Street being pompous and just downright I don't want to pull the race card here, but it's just no one took this guy seriously. And Andrew Toy hit this. Andrew Toy hit this in his LinkedIn post before. He talked about how much he experienced as an Asian American running a company and all of the just the bullshit that goes with it. New York, Wall Street, it's a pretty privileged place. I mean, look at Nvidia, right? No one believed them, right? And then all of a sudden now everyone's wanting them. Andrew had to prove himself a lot more. Like how do I say this in a way that again, I'm not trying to cause any issues here or anything like that. But the what's a great way to say this? People laughed and mocked Clover Health, and if this was any other company, Clover wouldn't be $3 right now. You understand what I'm telling you? They literally did a share dilution from a primary raising to get Chamath and investors in at $5.75, right? Clover's worth much higher, and that was a long time ago versus where they are now. No one thought that Andrew was going to create a company that was actually going to change healthcare. Everyone laughed at him. Everyone laughed at him. They didn't take him seriously. And it's great. It's a great story. It's like screw you guys, right? But Andrew's been dealing with this with his whole life, right? It happened a little bit after COVID, right? In terms of COVID and whatnot. But this guy's been through a lot, both professionally and personally. And he's made a lot of people around him multi-millionaires, right? And if you don't know this, you should probably look into his story. He sold a company to Google at such a young age. What the hell were we all doing, right? When he was, this guy is Wall Street did not Wall Street really miscalculated. Okay. To a point now, they miscalculated so much that they're hemorrhaging billions of dollars. Healthcare, ladies and gentlemen, healthcare is hemorrhaging billions of dollars is being just sucked out of healthcare. And then you have gentlemen like this that says something like this.
Old stop. In Florida, Joseph.
Hey, Jim, how you doing?
I'm doing well. How about you, Joseph?
I'm fantastic, man. So what's your take on Clover Health, ticker symbol CLOV?
Oh man, I don't want to get. I know they're doing well. United Health, after what happened the other day with the medical care advantage, I just don't want to go there. I know that it's a good company, but I just don't want to hurt anybody. I'm sorry. So let's go to David in Texas. David.
It's a good company. I don't want to hurt anybody. I don't understand. Listen, guys, the last time Jim got emotional, what does that tell you? Listen, guys, my commentary, sometimes it may seem like it's out of place, but I do things in an order of how my mind works. Okay. I just showed you of a video of Jim Cramer getting emotional in Meta stock. Okay. What happened to Meta? 5-bagger. Okay. Clover's a nobody. Clover's a nobody. It is just a speck. And here it is. Him getting emotional. And it goes back to that central topic where I believe his name is Market Cap. He published this here. Give him a follow. He quoted Vivek saying, "In 10 years, I strongly believe that it is possible for Clover to have made the biggest positive impact in healthcare." And this is where it gets the market cap, while simultaneously accruing the largest market value in healthcare in excess of any healthcare company that exists today. And you know what's crazy? I think this guy's crazy. These people are insane. I think when they say in excess of any healthcare company that exists today, you know who I think they're talking about? And it's giving me goosebumps. Right? I think they're talking about United Healthcare. That is insane. That is insane in the brain. Holy crap. It's one thing to go ahead and talk about Humana. That's understandable. But potentially to go after something like United Healthcare, you guys that are watching the video right now, we got about 36 on YouTube, and we got about 86 on Twitter X. So about 122 people watching right now. You can see it here, about 36 on YouTube, around that. Then 86 on X. Again, I'm not trying to again, this is not financial advice. Please take this as a grain of salt. Please take this as a grain of salt, right? But it is right now December 28, 2024. And the people that are watching this channel right now and the folks that are in Clover, again, this is not financial advice. This is just my opinion. I think you guys in the next 10 to 20 years, I think you guys are going to be so freaking wealthy, all of us, that we're going to look back at this video and we're going to laugh. We're going to laugh. Moments like this are very hard to find. And holy crap, if they go after the big dog, then you know everything else will follow. If this becomes true, in excess, it'll accrue the largest market value in healthcare in excess of any healthcare company that exists today. Guys, these people are this is revolutionary. This is crazy. This is crazy. This is crazy. Now again, I'm going to speculate. Okay. United Healthcare is 469 billion. Okay. Let's just say we get this. And again, 100 billion left United Healthcare. Let's just call it 469 multiplied by 2. We would get a $938 stock price, right next to what James was saying. There are people, the average shareholder on average in our account, we had got around 200,000. That's $187 million. That's $187 million. Now, let you go ahead and do the options here on that. Let's say we do 4% per month. That's about $7.5 million per month. You multiply that out by 12. You're making $90 million a year, right? Divided by 12. Let's go ahead and divide it by 0.04. We'll go to 187 million. Now, let's say we do 1% per month, which is very doable. That's this much. 1.87 million per month. I mean, I'm telling you, lives are going to be changed. This is insane. What's going to happen? Big philanthropy institutions are going to be made by the holders of these people in our platform. This is insane. The money that is involved here. We were never, ever supposed to see Clover at 60 cents. We were never supposed to see that. That was book value, guys. That was freaking book value. Like, if this guy's prediction comes true, holy shit. That's all I have to say. Let's go ahead and let's listen to the rest of what Steve was saying here. And yes, they were a little harsh. Is the sound not working? Is the sound not working? Are we? Uh-oh. Whoa. Whoa. Let's see. My bad, guys. Let's go ahead and just share it again. Probably an error in the system. Let me know if you guys hear this.
3-star, then they're not as attracted to it. Number one. Number two, there's also the quality of care measurement. So you can get bonuses for quality of care depending upon where your star rating is. Obviously, a 4-star. This in particular, they're talking about the star rating coming down significantly, which could affect 50% or more of earnings in 2027.
Thanks, guys.
So right now, 2025 is set, 2026 is set. But here's what they can do. They're appealing Medicare's findings. So they actually knew that there was something going on here. The star ratings were put up by a third party, and we don't know if they're going to be reliable or not. Directionally, they're right. So here's what would happen. By October 10th, Medicare will come out with their star rating conclusion. So you have some runway to that. Additionally, in 2027, there's a lot they can do before 2027, which is make acquisitions to drive revenue. But right now, the stock would be expensive if these star ratings hold, because they'd lose one large contract. So going back to your question, right now, I still think you could move up. But if it gets to be, say, down only $40, I'm gone, because that's a good trade.
$4. $4 difference from here is done.
It's like a percent.
Conversely,
No, it's like 2%.
Exactly. But
so you're playing a trade for 2%, Weiss?
You put a significant amount of shares in it. It's dollars. You see, you use a benchmark.
Stock.
You use a benchmark of what the S&P do. I use a benchmark of how much money am I making.
All right. Here's what we're going to do. Next time, we're not even going to mention it.
It's your call, man.
How about that?
I didn't lobby anybody to
How
mention
about that?
this. I just said
next time we're not even going to mention it, because it's too confusing for the viewers to figure out. Well, when is he in? When's he out?
Scott, I only mentioned it. I didn't say I want to come and talk about it, but I give our viewers a lot of credit as they.
I give them tons of Tons of credit, but you're not going to.
I'm not criticizing what you said. I think that they could say, okay, there's upside here. I gave them the facts. They may think there's more. They may say 25, 26 earnings are in the bag. I'll worry about 27 when it happens, and remedial action they can take between now and then. I guarantee you a lot of comments will come out to that.
Okay, that's fair. That's fair. Just want to make sure we're doing
We're
what we got
all
to
aligned.
do.
We're 100% aligned,
We are?
except on Hocus. I prefer Sans.
A lot, believe me, a lot of others. I've seen you wear some stuff. We're not aligned fully.
Yeah. So, guys, it's they because it was very blatantly obvious that, his calls weren't the best. And a lot of folks kind of lost money in this, and it was very clear because when you have a stock down 45% and it doesn't rebound, you can't sometimes there's a lot of poop that you can't hide. And now let me, because again, I'm not trying to have diarrhea of the mouth here, right? I'm not trying to have diarrhea of the mouth, but the thing that I want to say is that let me just pull this up here. The thing I want to say about Clover, guys, is like I told you last year in 2023, I said that 2024 is going to be the year of proof of concept. Okay. They removed their unprofitable side. They still got a little bit of fat from the ACO payment. They removed that. Now they got to work on that SG&A and be able to increase it to where they can become profitable. They're still not profitable. They are from an adjusted EBITDA. But the thing is, I want to see actual EBITDA, real GAAP metrics, not adjusted. I want to see real metrics of profitability. So I want to get to those levels, right? But overall, this year was the proof of concept, because if you look at Clover, it's up 239.58%. This was the year of proof of concept. I mean, it got to a point where from the bottom low, it went up this year. It went up 600%. It went up 6 bags. Okay. Now it's only up 4 bags, right? Only 4 bags, right? Because that's bad, right? The point is, so the question now is, what's going to happen for 2025? And I think now everyone and their mama is taking Clover Health seriously, because now when you Google Clove, you still get AMC and you get GameStop, right? And obviously you get NASDAQ because it's in here. But what people are starting to Google now is they're starting to Google Humana. And you're starting to see Clover to Humana. So people are starting to make the connection. The connection between AMC and Clove, that's slowly evaporating, because this is an actual business. AMC, obviously it's a business, but in terms of right now, they are fundamentally weaker from their fundamentals than Clover. As of now, AMC is weaker than Clover. And people are starting to see that. Okay. So they're starting to realize now Humana, the money might actually start going into Clover. Again, not financial advice. This is just my opinions. Okay. So personally, I think next year, I think Wall Street, and we're already starting to see this because Clover is ranked in the top 250, 260 best stocks in the global market based off of the Fintel's fund, right? Fintel's quant fund, right? And it's the top best 76 stock in the United States stock market. In fact, Lunar went up from 13 to 20, and we called it out earlier, and then all of a sudden it went up more, and we were just basically talking about it. I was in the top 80. We can go ahead and look at I think Clover Health chat. We talked about it for folks that are in our platform, in our private exclusive Clover Health chat. So the point here is kind of like, what is my expectation going forward? So as I said, the year 2024 is going to be the year of proof of concept. I think now the year of 2025, 6, 7, and 8, 9, and 2030, I think those years now we can conglomerate them to basically create some form of like overall summary. I think personally, I think those years are going to be the years where hedge funds are going to start realizing that Clover's a winner, and they're about to start jumping ship, and they're about to get into Clover. And I think that's when I would say we're going to make our money. Because again, you know, it's only so much you can make with retail investors. If you look at Palantir, you know, or Tesla, those stocks, smart money jumped in, and they're going to make us money, right? Now the question is kind of, you know, when retail investors, and this is the issue, right? This is the problem, right? This is where I'm sitting back here and relaxing as I'm talking to you guys. You know, I think this is where the problem happens, okay? You know, sometimes it's not easy for people, but you know, in my opinion, right? This is my opinion. I think it's easy to hold a stock you're down in because we've created a culture of diamond hands, which unfortunately it's like dumb hands, because the problem is people were diamonding AMC when the fundamentals were trash. And you could do diamond hands, but this is what it gets you, right? I mean, just when you think it can't go lower, somehow it just goes lower. This is diamond hands, right? So you got to be careful. But the point is, it's easier to hold a stock when it's down. I think what's going to end up happening is, I think this might jump to, let's say, $13, maybe, right? 13, 20, 30 bucks. Like, just imagine if this thing jumps to, like, let's say this thing jumps to $10, and all of a sudden it drops down to $4. It drops down to $4. What do you think people are going to do? Let's say it goes up to 10, drops down to 4, up to 10, drops down to 4.5, up to 10, drop down to 4.7. Like, I'm giving you a scenario here. This scenario played out before, and you're going to basically say, what are you talking about, Al? It's never gone 4 to 10, 4 to 10, 4 to 10. Just watch, okay? How many times has the stock went to 90 cents to $1.26? That's a 30% gain. 90 cents. This was a 66% gain. Went up another 20% gain here. Another 15%. And then it went up here. And then what ended up happening is, I had people that told me, Al, I ended up selling at 120 because I thought it was going to go back down. And I mean, do you blame them? I mean, it literally went up, went down, went up, went down, went up, went down. And then now it's going up. And all of a sudden we're like, oh yeah, it's going to go down. And all of a sudden Vivek buys, and then all of a sudden it shoots up. And now people are like, oh yeah, it's going to go down. It's going to go down. But all of a sudden it went back up. And then all of a sudden it went down. People are like, oh, I'm going to buy it. I'm going to buy it $2.50, $2.20, $2, $1. The point that I'm trying to tell you is, there were people that bought at 80 cents and that sold at 120, bought at 90 cents, sold at 120, bought at, like 80 cents again, 70 cents, and then they sold at 120, 110. And then all of a sudden, it shot up. And then the problem now, I mean, didn't this happen to Ken? Ken, I don't know what number for you. I think you sold at 144, and then you bought back in. The point is smart money is going to come online. I mean, obviously smart money jumped in here, right? So smart money is going to come online, and they're going to push the stock to 10. Then they're going to drag it down up to 10, drag it down. And what's going to end up happening is, they want the seesaw pattern, because they want these retail investors like fish that don't have any GPS, don't have any systems. They just have their fish eyes to basically go in and just, sell the stock at, let's say, $5, or, they sell at $8 or $10, right? And they're like, it's going to drop down to 4. I'm going to rinse and repeat. And all of a sudden now it's instead of $8, it jumps to 15, it jumps to 18, then it jumps to 20, then it jumps to 25, right? So the thing is this happens, okay? And it is what it is, right? It is just like the Italian people say, it is what it is, right? It is what it is. And if you know it, you know it. You don't, right? The point is I think it's harder for folks to hang on to their money because just imagine, let's say you have, I don't know, let's say you have 100,000 share. Let's say you have 200,000 shares or whatever on average. What do you got? Like what, 700, 800,000, whatever this is. Let's say it goes up to, let's say, $10. You make like $1 million or something, 2 million. You're let's just go ahead and do it here. You make 2 mil, right? All of a sudden it drops down to $5, right? And then all of a sudden now you're down $1 mil, right? So you go in and you go down $1 mil. Your brain's gonna. B-Rob mentioned this to me. You said this, didn't you? He said, man, I'm down a lot, from that $4.20. As the stock goes higher, I make more money, but when it goes down, I lose that money, and I feel like I lost that money. Just imagine though, if it goes to $10 and it goes down to $5, it's gonna show you lost $1 million. Sometimes people have a hard time dealing with this. Sometimes they see that and they're just like, "Oh my God, I lost $1 million freaking dollars," and then they start getting into what could I have done with $1 million? I could have gotten a car. I could have gone to a better house. I could have paid off the house. I could have saved for the kids' college. And this is where like Wall Street plays these mind games with the retail investors, and they take your shares, right? They take your shares because ultimately, retail investors, they just don't know. They just don't know. I'm going to tell you, when you buy a share, when you buy a stock, you're buying a piece of the business. So think of like, for example, and it's good to go over these fundamentals. Let's say, think of like McDonald's, right? And pretend you're buying McDonald's stock, okay? And I want you to take and think of a McDonald's building. And I want you to cut the McDonald's building in little squares, and each square represents a share. So let's say you have about 1,000 shares of McDonald's. You have 1,000 squares that are the piece of McDonald's. So every time McDonald's sells a burger and they make a revenue and they make money, and let's say they pay their employees, and let's say whatever they have is net income, that money ultimately gets divided by all of the sum of the little squares that are called shares. And then you have 1,000 of those shares. You're going to get some of those profits. Okay? But this is where it gets tricky. So the problem is, what happens if I buy McDonald's? Like, let's look at the stock right now, right? McDonald's stock. It's $239, and let's kind of look at this, okay? Let's say, and again, it's slowly been going up. And the question is, you have to ask yourself, why? Why is it going up, right? So those are all good questions, but let's just kind of focus on this year chart, okay? Let's say, for example, I bought McDonald's at $300 back on the beginning of January. I bought each. Wait, you mean 293? What did I say? I'm sorry. Yeah, but $300 is right here, though. You can see it was 300 here. Sorry, I meant 300 here. I don't know what I said. Sorry, $300. I don't know what the hell I said. I'm sorry. So $300. Let's say I bought on January 23 in 2024, and I bought McDonald's at $300. So what that basically means, and let me just headphone off. It keeps distracting me as it keeps falling off. Freaking AirPods don't even fit in my freaking ear. Okay, so let's say I bought $300 a share. That means that every share in McDonald's was, when I bought it, worth $300, meaning that when I got my 1,000 shares of McDonald's, I paid $300 per little box. So that means that every time that McDonald's sells a burger and every time they pay their employees, and that profit they have that's left over, those profits gets divided by the amount of shares that they have in McDonald's. And since I have 1,000 shares, I get whatever those profits come to me. Let's say I get maybe, there's something called earnings per share. And let's say I got $3 earnings per share. Okay. You see what I'm trying to do here, guys? I'm trying to teach you fundamentals here. Okay. So I got $3, okay, because of my ownership in terms of the stock. But here's the problem. How do I know, is $300 a good deal for the shares, or is it worth $247? Or let's say, how did these people back in the 90s that bought for $8 per share, or let's say the people that bought for $15 per share here, how did they know that this was a good deal? And how do they know to hold for the future? You see, this is where we start getting into something called intrinsic value. Okay. This is where we get, and this is why it's important to have the software part of the Al Stock Trades platform. And it's also important to have the intrinsic value calculation, which is part of the lifetime access, right? And the reason why it's important is what you do is you take the growth rate of McDonald's, you take the last 5 to 10 years, you see how much they've grown, you use that as a percentage, and then you look at their free cash flow. And then you take the free cash flow through an algebraic equation that the intrinsic value calculation calculates, and it goes 10 years into the future, because $1 today, if you invest it correctly, should be worth more in the future. You go in and then you discount it back at today's present value, and then you get the ultimate worth of the business. And then you take the ultimate worth of the business and then you divide it by the number of outstanding shares. So then you start to see, oh, McDonald's, let's say, is worth, I don't know. In fact, let's just open up the help menu. There's 2 different types of intrinsic value. There's the manual one, which I think is the superior version. And there's also, here's MCD as a ticker symbol. The manual is the better one, but we also have the automatic one. So we'll do the automatic one for now, just for purposes of time. So McDonald's is worth 300. So this calculates the value of McDonald's. And the thing is, since McDonald's is positive free cash flow, then this automated intrinsic value calculation that we have on the stock terminal, it gives you that McDonald's is worth $349.74. Now, let's go, and again, it gives you kind of the years and all everything for that, right? So it's pretty good, right? So now let's go ahead and look at the advanced leverage DCF, which is the intrinsic value calculation. You could see that is saying it's 273, right? So then you would go in and do different types of calculations. And then you could go ahead and do a normal DCF. Again, there's 3 different types of intrinsic values that you guys have access to for the stock terminal. You go and put that, you do that. And this one is saying it's worth, 273. But that first one, it was saying it was worth $349.74. So then you would want to then check to see, okay, what are analysts saying McDonald's is worth? And a lot of them are between that 257 to that 340, 345 as the high. And what do we get? What do we get for that thing? We got 349. So our intrinsic value calculated 349, and analysts are saying 345. So the point is you take the intrinsic value, right? We take the intrinsic value and we essentially figure out what the cost is per share. And once we calculate the value of the company, we then figure out kind of where the stock is. And if we calculate the value of the stock, and let's say it's worth 349, and let's say McDonald's right now is worth 293, then I'm like, oh, if we take kind of, let's say we take 349 and we multiply that by 20%, that's about $69. We take $69. So it's McDonald's is a good buy at 280 because that's a 20% margin of safety, 20% margin of safety, which is, a good buy zone around that time, right? And then you can essentially make that money. So I assume if you were to go to McDonald's and every time you saw the stock at 280, you probably saw a huge buy. So you could see here kind of 240, 230, 248, 251. So you can see kind of that 250, 280, that was a good region to get in, right? So again, once you start doing this a lot, you start realizing that you're actually investing in a piece of the business. So now let's say you go in and you bought it, let's say right now you say you bought it at, let's say 293, and you used a 10% discount rate. What that basically means is that I'm okay buying McDonald's at $293 and I'm going to get a 10% discount rate, which means that every year on average for the next 10 years, I'm going to make 10% per year. Now, next year, you could make negative 1%, right? Or the next year after that, you can make 30%. But then you make 20%. And if you average it, you get 10%. The thing is, if you increase the discount rate, what you're doing is you're increasing the margin of safety. And by increasing the margin of safety, what you're saying now is if I do a discount rate of 20%, I'm expecting to make 20% per year for the next, let's say, 10 years, right? So the higher the discount rate, the higher, obviously, the higher the amount of money I can buy. So I'll give you an example, and I think this example should help. Okay. So let's say I open up the intrinsic value part of the lifetime access for folks. Again, I'm telling you, if you want to be a master in the market, you got to learn this stuff. We have a platform. We have people that are like-minded. If you want to remove your fish eyes and put on some GPS meta goggles, you can join our platform. I had to. I think that was really fun, the fish eyes. Okay. I don't know where I came up with that, guys. I don't know. So let's just use the numbers for Clover. We have 118 million. We're growing 10%, and we're growing at 9 point. Sorry, we're doing 10% into the future. We're growing at 9.33%. We're going to go ahead and do 501 million shares. Mm-hmm. And you can see we're trading between the bear case of $2.92 and $3.74. So if you were to buy Clover at $5, we can expect a 10% return. So let's figure out what's the percent return right now for Clover, because Clover is currently trading at 326. Okay. So we'll go ahead and do this. So we'll do discount rate. And again, we got to fix this. I think Clover is going to turn on growth rate to 25%. Right? So if we do 25, let's just do 9.33% now, and let's figure out kind of that, and then we'll do 25%. So let's do 12%. Okay. Okay, 13.5%, 13.7%, 13.8%. Yeah. So Clover's around 327, we can say. I expect 13.8% per year for the next 10 years if Clover were to stay at 9.33% growth rate. We know that's not the case. I think Clover's going to grow 25%, and I think their free cash flow was 25 plus, like, I don't know, 44 plus 49. Divide that by 3, multiply that by 4, because next year we're not going to have that ACO payment. I think we're going to have 157.3. But then we can say 25%, and we can go ahead and do 10%. Okay. So let's say the average value, let's say as of right now, this is not including SaaS, $21.16. So let's assume that. So let's figure out what would the rate of return be if we were to buy Clover at $3.27. So 16, 20%, 25%, 30%, 31%. There it is. So we could say 32%. No. What am I saying? 30%. We'll say like 30.5. That's good. And what is the stock price now? 326. It's okay. It's close. So 326. So 323. Right. So I expect to make 30.5%. This is another way of using it, right? 30.5% per year. But hold on for a sec. What happens if I bought it at 60 cents, which is why I was banging the table for Clover? So let's get, because Clover was getting free cash flow positive. I'm like, what the hell's wrong with people? People are freaking, what the hell's wrong with them? So let's get this green bar to 60 cents. 40%, 50%, 60%, 65%, 70%, 75%, 80%, 90%. Wow. So so whoever bought Clover at 60 pennies, you should make a 90% return for the next 10 years every year, which is in freaking insane. If Clover grows at 25%, they have to grow at 25%. If they grow less than that, you're not going to get 90%. It's before someone says, well, Albert, you said 90%. You have to grow at 25%. If you don't know that, get out of the stock market, go gamble, right? You'll do well, right? Right. I bet you will, right? So, but now let's figure out Clover. Let's look at the price of the stock. Okay. So now let's open up the homepage, and let's open up light mode. Let's open up actually 10-year progression analysis, and let's just call this like the stock price. Okay. Let's just put like 0.6 cents of the stock price, and let's grow them at 90%. So in 10 years, this is what's crazy. If Clover grows at 90% for the next 10 years, okay, that means, then I got to figure this out. I got to make sure. It's 15. So that means based off of this, we could see Clover at $350, which is insane. Based off of this is called a reverse intrinsic value calculation. This is insane. So 350. So let's see how this works. So in 10 years from now, 350 is equivalent to $175 billion market cap. Now, obviously, these market caps, like we're talking the top here, right? So we're talking like this is some crazy stuff, right? That's if everything works out, right? Which I think, again, I'm not the first person who's done these calculations. I think when you go ahead and go to Vivek and you go ahead and go to this comment here, while simultaneously accruing the largest market value in healthcare in excess of any healthcare company that exists, I think this is the case. So the math speaks for itself. 90% discount rate is insane. We can go ahead and curve it and say we'll just cut it in half and say 40%, which is still pretty good. And even then, you do 40% and you can get the stock price of around anywhere between 15 and 20 bucks. And that you just cut by half, which is not mathematically correct. So the point here is I think this company is going to accrue the most that we've ever seen. And again, lots of people say, "Oh, no, that's not how it works." Just to give you an example, back in, May 2017, if we can just find May, Enphase was 72 pennies. Guess what the stock went up to? The stock went up to its peak. It went up 46,000% more. And it was at $333. So the question is, has this happened before? Yes, it has. So that's kind of where we're at. So, but the thing is, a lot of things need to happen in order for this to actually play out. And we'll go ahead and watch, and we're going to relax and figure it out. And the beautiful part is we're going to be releasing the options analysis part in regarding my wheel strategy when I do my options analysis from the FU money side. And people are already seeing how much money people are making some good money here, right? So again, the whole point of the stock terminal is to exchange ideas, to exchange strategies, and to figure out what other people are doing that's making money, right? And that's it. So in terms of Ivan here, watch my video on SoFi. We called it out when it was like $6. So we did a price target on it. We can go ahead and redo it. It's up pretty good, 17.34 billion. So it's pretty good. There it is. Love you, Patrick. Again, for folks that want to become part of our lifetime access group, it's an amazing group. I think it's one of the best groups, but of course I'm biased. Put the coupon code New Year, lifetime access, one-time payment. You get access to everything we get. We will be increasing prices by $1,000 more, so take advantage of this, right? So you're essentially technically getting $1,700 off because you're getting the extra $700, and they're going to be increasing prices. All right. Appreciate you guys. Hit the like button. Definitely helps with the YouTube algorithm. Patrick, love you a lot. Listen, guys, we got some really good. We got a good year ahead of us. Lots of change, lots of disruption. We're free cash flow positive on a fiscal year basis. We're about to return to growth. We're being advertised as 4 stars. 2026, we're going to get a 5% boost on the 4-star ratings. We could potentially even get to 4.5 stars. We got the 5th quarter of revenue from what Peter was saying in regarding to the SaaS deal announcement with Iowa Clinic. We have a lot more partnerships that are potentially going to be lined up. We potentially have a partnership with Molina Healthcare in accordance to the board of directors on Molina. There's a lot of things to look forward to in this company, and I'm just very excited to basically share this with you all. A lot of us out here that are watching right now, we're going to be basically like the folks that invested in Bitcoin back in 2011. We're going to be chilling. Right? We're going to be in the future now when people watch these videos right now. Sadly, if you're watching this 5-10 years from now, you're too late. I'm sorry. Right? But we have a platform, and by then the platform is probably going to be $10,000 to $20,000, which is unfortunate. Right? But again, it's an exclusive membership. Right? But ultimately, there's a way out. Asterisks. Once automation comes in and you got robots day trading, good luck. But until then, all of us, holy shit. You guys are about, for the folks that, your guys' families and friends that are watching your lifestyle, for the folks that are watching this video right now, today, they're going to see some changes. They may see some green Lambos in your driveway. They're going to be like, what's going on? Are they having a midlife crisis? Why do they have a bunch of clover leaves in their front lawn? Ladies and gentlemen, I'm very excited for the future. And finally, we have an opportunity where we got lower than what institutional investors got in. We got lower than what Chamath got in. And Chamath, I'm sorry, buddy. We called out your poker face, right? I'm not selling. I'll see you on the next one.